Well, the stock market didn't start off all too well, but it slowly climbed itself back up, and then Biden entered into the ring and delivered a right-hand hook, knocking the market back down with news or rumors around the possibility of practically doubling the capital gains rate. My name is Michael Silva. You're watching the Daily Stock Market Brief Show. Today's date is April 22nd. This is the show that we do Monday through Friday, 5 days a week. We use technical analysis and intermarket analysis to get a good idea as to where the market might be headed next. We have timestamps in the description below. Before we hop into today's show, I just want to reiterate one thing. We get these spam bots that keep on popping up on my channel. They look like me. They're not me. I won't give you a WhatsApp number, and I'm not going to ask you for Bitcoin, so please don't get scammed. I'm only imagining the reason why they keep popping up after the hundreds of them that I block is because it's working. That'd be my only bet. So please be very careful out there. Let's go ahead and hop into today's episode. Alrighty, welcome back. We're looking at the market dashboard. What's one common thing that you can see across the board here? Blood red. That's what I see across the entire board here. Holy moly. The only thing green was obviously the VIX. Dow Jones down 321 points. I can't believe that this was up on the day, and then almost immediately after that rumor or news or whatever you want to call it came out about the possibility of the capital gains tax being doubled. It had like a 400-point drop rather quickly. I'm sure you guys all witnessed that out there. As far as sectors leading the way, real estate up at the top, and we have materials down at the bottom. Nothing revolutionary taking place right here. We've got to get into the charts to dig a little bit more deeper as to what might be going on next. The S&P 100 took the biggest hit on the chin today, down 1%. Let's get into the S&P 500 daily chart. And what I want to call out here that you're going to be noticing on multiple of the charts is just the current candlestick pattern. We talked about this yesterday being a very bullish looking candle. The previous day, this big green candle from open to close, so gap down and flied through the body of the previous day. But today, what do you know? The blow was delivered at about 1 o'clock, and you can see here, this is a bearish Harami type candle, potentially a bearish engulfing. The name, it doesn't actually really matter, but what I want to show here is where it opened up within the candle of the previous body, and then it closed right there within the body too as well. So what does this mean? Well, I mean, given the context of it, it is in bullish context overall. It is kind of just riding on this area of resistance. This is very similar to what took place over here during February of earlier this year. So this to me is more bearish looking now. It was bullish yesterday. Now it's back to looking bearish. So we got to just be very careful during these times, because this is like a distribution type of price action where you see these big swings back and forth and a lot of indecision as the days progress. So this could be potentially a bull flag, but we're going to hop into the 30-minute time frame to get a better idea as to this. Now, what do we need as far as confirmation goes? If we start closing below this 4,100, maybe 41.25 area right around in here, that would suggest that this is a more of a bearish candlestick pattern, and we would get confirmation to the downside. That would make sense to me. So let's keep an eye out for that. But it really went from bullish to bearish very, very quick. So let's see how the market kind of digests this news going forward. S&P 500 on the 30-minute time frame. Look at, we called out this kind of breakdown right here and then the recovery. And as soon as it was kind of right back up within here, it got rejected very, very quickly. The gap was not filled above us, so this inverse head and shoulders, it is now no longer an inverse head and shoulders just because of today's price action. 200 days sloping up still. This could be potentially forming a bear flag. We have support still right at around 411. So if 411 kind of breaks down, that could be a very bad sign, and we could see that this be a full breakdown where we come fill this gap right around 402. So that's in the cards here. So we'll see how this kind of price action here settles throughout the rest of the week here. Now, I do know that, Friday's just around the corner, obviously, and Fridays typically you had these VIX crush days, so I wouldn't be too shocked to see the market all of a sudden turn back up tomorrow But we will see, because typically how Friday kind of acts. So for example, if we have, Friday kind of end off going lower and lower, we might have continuation into next week going a little bit lower and lower. And or if it goes up, we might see a progressional move to the upside come the following week. Let's look at the Nasdaq now. Nasdaq, very similar price action, bearish harami type candlestick pattern. Could be a bull flag, forming. In bullish context still too as well. Just note that if we do start cracking below the low of today's candle, if we get a confirmed close below, the low was at 334. If we start closing below that on the day, it does suggest that we could get continuation to the downside in the weeks to come. Now, we talked about this inverse head and shoulder. We broke out. I think that a back test would be a great opportunity to go long. And when you look at the price percent oscillator, it's crossing over right here, a bearish crossover. To me, I don't like. I think that 3, 4, 5, 6% correction would be good for the markets. I mean, we've been just going a straight line up, right? In the month of April, it's been a straight line up. When May comes, they say the saying is, sell in May, go away, or whatever the case is. But it's to me personally, looking at just the bullish context of everything and how euphoric the market is, I think that a pullback would be nice for a long position entry to all of a sudden spike into another high. I do think that this right here is not a market top to a bear market. I do think that we will be breaking out of this area and heading higher on the various indices. So that's kind of where my mind is at, and I'll talk more about that in the conclusion section. As far as a 30-minute time frame goes, this does look like a head and shoulders type formation, kind of working itself out here, a very sloppy one. But I would say that if we start getting below that 334 or 332, you can see more clearly that we could potentially head lower and fill some of these gaps that are beneath us. The semiconductors did also take it on the chin today, down 2.3%. Also just a bearish looking type candlestick formation here. So it does say to me that we could target this lower Bollinger Band and this previous breakout, and that could end up being a good entry point for some semiconductor stocks. So let's keep an eye on that. Dow Jones, very similar looking to the S&P 500. Still overall bullish context with the 20-day sloping up, 50-day sloping up, 200 sloping up. However, just keep in mind that if we start cracking below the low of today's candle or get a confirmed daily close, it does suggest that we can head lower. This just very similar to the S&P 500 back. When we get into these areas of resistance, they kind of just distribute, go back and forth for a little while, like we did see right here, and then bam, to the downside here. So reversals have to start some way or another, and this is one way that how they could start, by seeing some candles like this. Another candle formation that's similar to this was right here. You had this big green up day. It looked like it was breaking out, but then it was quickly reversed, and we had some follow through, and it continued lower. So it's always a possibility. You just got to be prepared. And just got to be ready to move very quickly in these market conditions. Here's the DIA on the 30-minute time frame. I just wanted to point out a low here, a lower low here, and we're still running to that area of 37, which is right where the 200-day moving average is. I think if we start cracking below that, that would be that gap fill down here, right around 331 to 333, this zone. That could offer up a good potential long entry for either a day trade, intraday trade, or potentially even a swing trade. Just depends on how it kind of works itself out. Here's the transports. This to me is this is on the 4-hour time frame, a nice bull channel, but I want to call out here the uptick in volume right here as it's showing little signs of weakness. So this to me is, if this starts breaking down, that's not a good sign for the industrials. So if we get a breakdown through this on the 4-hour time frame, I would imagine that we'd see more weakness in the industrials as well. So let's keep an eye on this kind of bull channel here that I kind of noticed on the 4-hour time frame. It is just kind of gliding along right here, this lower channel trend line. Then the Russell 2000, we're going to look at just the daily time frame. Down very slightly on the day, shooting star type candle. So, we still haven't cleared that 225. The high today was 225.33, but then it quickly got reversed. I think that if we start getting daily close above that, it does suggest potentially higher. A lot of people say that this is a head and shoulders pattern. A very interesting type head and shoulders pattern. And you can have head and shoulders patterns like this where it has, multiple shoulders, and ahead right here, but just note that if we start breaking above that, then that kind of makes that whole theory go away. And then, like I've been saying on this show, this neckline or this area of support is right around 210, and 210 on the monthly time frame for the IWM is where the monthly 5 EMA is, and that 5 EMA can act as a level of support. So if we come down here, it could be potentially a good risk versus reward opportunity to go long if you do believe that the market is going to continue to press higher. Even if it goes and cracks through it, it's still a very easy trade to manage given the context of that kind of position. So just know if we do crack below it, it does suggest further downside. So just make sure that you are monitoring and managing your risk. Let's look at some stock market indicators. As far as breadth goes, breadth is negative on the day. Obviously, it was a little bit of a weak day today. It was significantly weak for the most part, gap down, but then it came back up and then it rolled itself back over. But as far as a breadth perspective goes, nothing that stands out to me here, so nothing quite worth noting. As far as the percent of stocks above the 200-day moving average of the S&P 500, slight down day today, but nothing too crazy to point out other than the fact that I've been pointing this out very frequently, saying how overextended it really is. And then when you look at the bulls to bears survey, this is just checking sentiment. I just wanted to call out the bulls to bear ratio, slight negative divergence. We've seen negative divergences take place where you have the market roll over. This by no means is a signal to trade. It's just giving us, it's basically saying, okay, sentiment is very, very bullish right here, right? And when sentiment is very, very bullish right here, that is, it just tells me that there's a lot of exposure to the other side of the trade, which would be the bearish side. And you can see that here, even bears aren't really bearish, and then the bulls are pretty darn bullish. So it just says, and you can also see that in the NIM exposure index too as well, and the right X is at a very, very low point right here. It could be a record. And then you have the NIM, the asset managers are almost here at 100. So it just says to me that everyone is completely risk on, not a care in the world, very, very bullish context. And they might be right? Even if we see a 3, 4, 5% correction, that doesn't take away from the fact that we can't go rip to new highs. So that is something worth noting. But just also note that when you have everybody on one side of a trade, that means if things go the opposite direction, they shift very quickly, which can in turn make it more of a progressive move. Like for example, when you saw everyone's bullish here, just how fast everyone switched positions and adjusted. And obviously the move to the downside was very, very aggressive. You can see that here, and then you can see that here, how they quickly adjusted down. So just be prepared if that's the case. They will make their moves, and they will make their moves very aggressively. As far as the null goes, new high, new lows, slightly up here on the day. Still a negative divergence in place though, so we'll continue to monitor this divergence to see if it actually holds true and we do start breaking down on the NDX. As far as a volatility perspective goes, this is interesting to me. Notice the Bollinger Bands. They're tightly contracting right now. You can see the upper Bollinger Band's heading lower, and you can see the lower Bollinger Band is heading higher. All right, so the Bollinger Bands are contracting, and when they contract, you can typically see some sort of expanded move shortly thereafter. Now, we're not quite there yet. We might be. You have the RSI kind of cupping itself back right around just below 50. But you can see here on the Bollinger Bands, they contracted very tightly. And then bam, plow right to the upside. They contracted back over again right over here for, the 15 days out of October, and then bam, it expanded to the upside. Then we had this long period from December to about February where they contracted very tightly, and then we had that move to the upside. So this could be a period where we're contracting. Maybe we move sideways for a little bit, but just take note that it is contracting, which typically these Bollinger Bands, when they contract very tightly, do lead to some sort of kind of explosive type move in some cases. So we'll continue to monitor that and see how this one plays out. The last one I want to call out is still this XVG. Still does not match this move by any means. You can see we had a negative divergence here, and both of those led to market sell-offs. Here, it's not quite a negative divergence. I mean, you could argue that it is. They're basically a double top right here, and then this was putting in a high to a higher high. So it is there is a divergence. It doesn't quite match the move. It's very similar to right here, to be honest. The XVG here, here, and then you can see it was a high to a higher high, and then that move got completely reverted back. So if that's the case, and we get a complete reversion back, that can bring the S&P 500 to around 4,000 rather quickly. So you know, it's something to take note of. It doesn't mean that it's going to happen. Like I said, overall context is still very bullish. But it would be good. It would be healthy to see the market actually pull back and have a good like cleanse take place before we go reach out to new highs. Now let's look into some commodities. Oil slightly up on the day. It started with the gap down, started moving up, closed below the 50-day moving average. We'll see how this one plays out. I mean, I'm in a trade right now for oil, so I'm a little biased. I would like to see the price of oil go up. I'm in energy, sorry. But typically when you see energy start to perform, or oil start to perform, that does benefit the energy stocks. Now, what's interesting today is energy, XLE had a down day today. Yesterday it had an up day while oil had this kind of pretty significant down day. And that to me, we called out on yesterday's brief. We're like, okay, well, maybe something's a little funky right there, but I still entered into my position. I just did it with protection. So just be careful per usual out there. Now, Bitcoin is going to be probably getting the headlines here soon. A lot of people are talking about it because of this little bear flag that we just recently broke down. Okay, so 52,000 to 51,000 is kind of a support zone right here. All right, so you can just see this pull, and then it's kind of just been taking little steps to the downside, and then if it breaks through, it can have a significant flush to the downside. So right now, it doesn't look like the best buying opportunity until potentially we get back and recapture that 50-day moving average. That'd be a lot more appealing in my personal belief. You know, take it for what it is, even potentially even this rising wedge and recapturing that area, because it could always just break down, back test, and then head lower, which would be that would be pretty dirty move right there. But we are below the 50-day moving average. Take it for what that's worth. The last time that has taken place was like October of last year, so it's been quite some time since we've actually been trading below the 50-day moving average. Now, when it did trade below the 50-day moving average, it made the 50-day moving average flatten out, which means the uptrend is kind of slows itself down, but it only remained down there for a little while before getting back above and making just a parabolic move. So that's always on the table too. As far as silver goes, be very careful here with silver. We're not out of the woods here in silver and or gold, which we've been kind of saying we need to get back above this kind of zone right here. Yesterday, very strong looking day with some nice volume. It looked good. Quickly reversed, still above the 50-day moving average. But I want you to pay very close attention to this candlestick pattern. This is a piercing pattern, and if that has followed through to the downside, that is not a good look for silver. I was looking somewhere else too, like right here. See right this where we had a big move to the upside here, or that big green day, and then it was followed through a piercing type pattern with silver. With the following day, and then bam to the downside. So just be mindful of that. It's very possible, especially if the dollar continues to find some strength, and we'll get into that chart here shortly. And then we got gold. Gold is breaking out. A little bit of a down day today, down $11, but still nothing technically too broken. It's still within this kind of 1750 to 1800 range. So this is nice right now. The miners look really good right now. Just know that it's still battling an uphill. It's still an uphill battle right now. You have it coming into this 200-day moving average, which is right around 1858. By the time it gets there, it'd be probably right around 1850. Nice round number, and it'd be leveled out, probably pretty flat. So that can act as an area of resistance too. So just look at this as, I would say, if we start getting above that 1850, that to me would be above the 200-day, above this previous little high right here. That would give a lot more support to this overall kind of bottoming type pattern here. And it would suggest that we'd have a lot more opportunities to come in the miners and stuff if we do get above that level. But we're not there yet. We've seen a little bit of weakness today. Another thing that's kind of interesting to watch here is the dollar. The dollar did have an up day, and it's still holding above the 61.8% retracement level. So this is kind of why I'm saying this about gold and silver right now, is if we start seeing the dollar bounce from these levels, well, that could put pressure, obviously, on the S&P 500 equities, but also gold and silver too as well, maybe even perhaps Bitcoin. So we've been falling through down here. That has been benefiting the S&P 500 in the month of April. Perhaps we just bounce up to around 92, and that acts as a resistance, and then we head lower. That's why I'm thinking that this whole S&P 500 or the various stock indices can head lower, but I still think that there's another upside potential. And why do I think that? Well, I think that the dollar is positioned to have a little bit of an up move right here. And even if it does go up, it's going to come into an area of resistance in this bearish trend. So that could push the other equity markets down lower. But then if I'm right about the dollar continuing to head lower, that would then project the various indices, gold, silver, various other assets up significantly higher. So let's see how that kind of plays out here in coming days. But 61.8% retracement level is still holding. If it starts cracking below that, then yeah, I think we're going to go test the yearly open, which is right here just below 90. All right, everybody, that's all I got for you. I want to show one special chart here that I forgot to mention, and that is the BKX. Now, the equity market, the financials are a very big, important part to these various indices. Like, for example, the IWM, 20% of its holdings is in financials. So if the banks struggle to perform, that puts a lot of weight on various equity markets. Or the equity market. So I wanted to call out here from a weekly perspective. It looks like this bull pennant this week so far is not shaping up to be the greatest looking candle. And you look at the price percent oscillator crossing itself over. This to me suggests that we could see some weakness. Another thing that I want to call out is the RSI have been overbought here, and it's kind of slowly rolling out of that overbought territory. So we have that mixed in with the price percent oscillator, bearish type candle. This could very well be breaking down here in the near future. And, as on previous market briefs, we talked about the red zone. And if we start breaking back down below that, I'll bring that chart up, on another episode, or probably on the weekly recap to discuss that. But overall, to bullish context, just looking a little weak right here, and that could be the early start of more of a pull down here in the various other markets. So that's all I got for you on today's episode, everybody. Confusing day on the markets. If you're feeling frustrated, well, you should be feeling frustrated just given the current context of this environment and this choppy nature. When that's the case, what I like to do is I like to reduce position sizing and then just play very specific setups that I find deemable or appropriate to trade in. All right, have a good day.